Hello everyone, happy Taco Tuesday. We are going to talk about gaming stocks today. So lately the markets have not been too kind to growth-oriented investors, and these stocks I'm about to talk about, they've been down, they've been hurt, but is this a buying opportunity? We have Draftkings, Penn National Gaming, and SCR Media and Gaming. In this video, I'm going to cover Q1 earnings, because why not? Unlike me, they make real money. 2, company financials and valuation, and last, my thoughts on the stock moving forward. Okay, Draftkings Q1 highlights. A loss of 36 cents per share versus an expected loss of 42 cents. A revenue of 312 mil versus 236.2 million expected. 1.5 million monthly unique paying customers versus 1.31 projected. Fiscal 2021 revenue guidance to a range of 1.05 to 1.15 billion from 900 to 1 billion. Okay, so we're on ticker terminal. And for those of you who didn't watch my last video, you should go check that out and give it a thumbs up. And so with ticker, you get all this information for you to use anytime you want. You can search up a company and look up their financials instantly. You have your statements here, and you can play around with the site and zoom in and out of time periods. So it's a really great tool, and did I mention it's completely free. So moving on, before we start, I'll just quickly go over a few terms for better understanding. NTM means next 12 months. So this is just a forward measure 12 months out of what a company is projected to earn. Enterprise value is the total value of the firm minus all the firm's debt. It's a little different from market cap, and it's used more so for valuing companies. So Draftkings next 12 months, you can see here is trading at a 13.23 revenue multiple. It's fallen quite a bit, and you can see what they were valued at the last couple quarters. EBITDA is a little wacky, and you'll see this with companies that are not profitable. So we're going to ignore EBITDA for now. So on a revenue basis, this is pretty high, but they are a growth company that just grew their revenues by 90% from 2019 to 2020 and is projected over 55% in 2021. Yes, they are expensive, but you're paying for very high growth, so just keep that in mind. And moving on to the income statement, you can really see that the legalization of sports betting in some states have really helped Draftkings grow a lot over the past few years. And again, I don't expect that to slow down over the next few years. What you will notice is that the gross margins have been shrinking a lot over the years, and that's largely due to customer acquisition costs. These gaming companies are really trying to compete for those customers in the way of pretty much giving money. And here, operating expenses are growing much faster than revenues at this point. So I mean, things seemed pretty decent on the earnings call. A smaller than expected loss, revenue estimates beat by 32%, more unique paying customers, and a raised fiscal guidance to top it all off. And so we're left thinking, why did the stock sell off? Well, when we dig deeper, the most concerning thing that investors should know is the ridiculous amount of money spent to generate that 312 million in revenue. If you look at the numbers here, you can see that the cost of revenue, sales and marketing, and G&A all went up a ton. This is adding up all to create a loss that's only going to grow as the company has been open that they will be increasing these expenses in 2021. All right, so my thoughts on the stock. So I feel like I can forgive some of these higher expenses like product and technology. They're working hard on their iGaming and media platforms, but I can't help but feel like they're wasting too much unnecessary cash on marketing and promotion. I know the online gaming industry is tough. You have different sportsbooks offering deposit bonuses and rewards, but you guys are Draftkings. You're already huge. And so I feel like what the company needs to understand here is that they can do more with less. For example, like their social media following, their competitors, the SCR Media and Gaming, they have over 2 million followers on Instagram, let alone their main, the SCR app. They also have a lot of followers on YouTube for their esports and gaming content. And then there's Penn National with their 30% equity stake in Barstool Sportsbooks. They have over 10 million followers on Instagram. And so I feel like this is an area where Draftkings needs to improve on. If I were investing in Draftkings, I think a question for all of us is how much we're getting back for each dollar spent on marketing and promos. They have metrics to keep track of this, so this is definitely something to look to in the future. I think Draftkings overall is a solid business, and that what we're getting with them is pretty much what you're getting with every high growth company. The numbers are not going to look pretty until they do. This should be a concern for investors, especially in a rising rate environment and a tech-led sell-off. but I do feel strongly that DraftKings is a winner in the long term, but do expect a jumpy ride, especially in the near term, until maybe after a year I can see the company trending higher as their path to profitability starts to show. Right now, I'm not sure how much I want to be betting on this company until maybe after I see another quarter or two, because if I see another ugly quarter, I will probably hold off unless they are just too cheap in that low $30 range. So on the Penn National Gaming, in Q1, the company highlighted income from operations $216.5 million versus a loss of $560.6 million in the previous year. Also, an improved balance sheet and liquidity, $2.06 billion cash, $672 million credit available versus $401 million in cash and $572 million in credit in 2020. So Penn valuation, forward multiples, Penn is trading at a 3.85 times EV to revenue and 11.37 times EV to EBITDA. On a revenue multiple basis, Penn is trading a whole lot cheaper than DraftKings. But we'll also have to look at how much the company is growing to be able to compare these valuations. And since 2016, the company has actually been growing very little. There's a good year in 2019, but this is followed by the pandemic, where then due to Penn also having a larger portfolio of casinos, they were hurt pretty bad and also unable to fully capitalize on the iGaming space like DraftKings and the SCOR. I think after the recent sell-off, however, Penn definitely does not look super overvalued at their current price of $78.23. While their growth pales in comparison to DraftKings, gross profits are up, margins are trending upward, as well as their expansion into the iGaming space is going to give them the boost that they need. I'll also note that their new CEO, Jay Snowden, is going to be very important in pushing the company to make the transition from being a majority physical gaming operator to a more hybrid gaming company. He's been with the company since 2011, has a ton of experience in the gaming space, and especially after his minority stake that they've acquired from Barstool Sports, that I have a ton of confidence in his ability to lead the company. I think one thing I need to highlight from Penn's financials is that the company wasn't making that much less almost 3 years ago. And the share price you'll see back then was in the 20s and 30s for most of 2018, yet somehow we find that the stock has run up so much more. Now, I'm going to say that has to do with a few things. Number one, interest rates. They weren't as low as they were back then, and despite the recent increase, we've pretty much gone as low as you can since the pandemic. And another, Penn wasn't as diverse and invested in online gaming companies as they are now. You can see it in the revenue multiples of the company. They've been increasing almost every quarter for the past couple of years. This is signaling to me that the company is ready to spend some money and make things happen. Penn will also benefit from the legalization of gambling as additional states open up along with Canada, and they've got physical casinos all over the country, so the reopening play is also there. I do think people are going to want to go out, socialize, and have those nights out again. Penn to me feels like the safer investment. It feels like I'm looking at the smarter, the more stable brother, the one your parents know they can count on. You're essentially trading higher growth for higher stability and financial performance and a reopening play. And you should wait till we check out the SCOR, because them to me feels like your cousin who bought Bitcoin and made $1 million. And so anyway, I think Penn is a solid play on gambling as a whole. They cater to both online and physical, and I do feel like they deserve a spot over DraftKings in your portfolio if you are more conservative. And so right now, I would probably just hold off from buying a little bit and maybe average in on dips if the possibilities do come. So the SCOR, media, and gaming. The company follows a different year end, so it's Q2 for them. The company in their earnings report highlighted a net loss of $17.57 million compared to $10.45 million in the previous quarter, $5.59 million revenue versus analyst estimates of $8.98 million, and an adjusted EBITDA loss of $8.26 million. Trading at 18 times EV to revenue, similar to DraftKings, we're not going to look at EBITDA because it's negative. So looking at this revenue multiple, it still looks pretty expensive even after it's fallen over 50% since its February highs. But we do know that their largest customer base by far is even yet to show up to the party. So unlike DraftKings that reported earnings that were much better, the SCOR did not do too well in Q1, though analysts had expected the reported quarter to be the weakest for all the companies. Reasons being that the MLB and NHL season had ended, the NBA playoffs were terrible and had the lowest viewership in a long time. NHL had just started without many fans returning, so there was a reason why things were bad. But still, while things don't look amazing, I will hold my breath and give them the benefit of the doubt on this one. I think Q3 and Q4 will both be better. I just know that they really need this Canadian legislation to pass so they can make some money already. The company is projected to take all kinds of market share in the Canadian space, and there are several differing opinions from analysts that say 10 to 20 to 30% market share. And so while we still cannot say what the real number is, even the most conservative estimates give them a much higher share price than the one that they are currently sitting on. So I noticed that one major concern that I had with Draftkings I did not have with the score. Sales and marketing expenses, while high, were not Draftkings high relative to the company. It's actually a much more reasonable increase even though the company generated less revenue due to a bad quarter. I think what this tells me is that the score has quite a strong advantage when it comes to attracting and retaining their customer base. Clearly, they have shown that their fan base is really top notch, and this has been exactly what the CEO, John Levy, has been trying to reiterate. The company has $45 million in cash, and if they can show an improved third and fourth quarter with narrower losses, they are setting themselves up to put up a good fight in their home territory against two larger companies and more. Of course, this can only happen if Canada's Bill C-218 is actually passed. So my takeaway on the score. They've been down more than the other two, but things could play out exactly for the right reasons as to why SCORE investors bought the stock in the first place. Canada's opening. And I'm Canadian myself. I love sports. I love watching sports. And believe it or not, I used to be an athlete once upon a time. And so I don't think only until recently that I had actually heard of Barstool Sportsbooks. And I know I've heard of Draftkings, but growing up, the score was actually a household name that we'd watch in the TV channel. And so I think this resonates with Canadians and is definitely something that we should be positive about if we are score investors.